Okay, we'll get this started. Well, welcome everyone. Welcome to OBI's Lunch and Learn, Startup Missteps, Real Scenarios from a VC's Experience. Thank you for joining us here. We're so glad that you are here with us. I'm Adrienne Klein. I am the Programs and Operations Specialist here. Also joining us is the Executive Director of OBI, Heather Ellis. We would love to connect with you guys, so we're going to go ahead and put our LinkedIn information in the chat. Feel free to connect with us. While we're here, just know that we would like for you to stay muted throughout the event. And if you have any questions, please feel free to put them into the chat. We will be answering questions throughout the program, so definitely get those questions in there and we will get them addressed after each scenario. Please feel free to introduce yourself in the chat and get to know each other there as well. Okay, so land acknowledgement. Otradi would like to acknowledge the land we are all on, wherever we may be. Otradi conducts business throughout Portland and beyond. It is making an effort to acknowledge the history of the area and work towards decolonization of the bioscience industry. To learn more about Portland's native, diverse, and vibrant community, please read The Leading with Tradition, a document created by the Portland Indian Leaders Roundtable, and we will also put that link in the chat. So lots of goodies in the chat. I want to tell you about some upcoming events. We have our very first happy hour happening on Thursday, January 9th. I just started promotion on this and it's already like blowing up. So guys, if you want to get in on this event, you will need to sign up as soon as possible. And at the end of the month, we have a workshop with Travis Rapley. He's going to be doing scaling biotech and medtech startups. So visit our events page and get signed up for those events. At the end of the program, a survey is going to pop up on your screen, and it's a really quick survey. It's anonymous. It doesn't tell me who you are, but you can let me know if you like the program, what you like about the program, and it just helps us make our programs better. In this Lunch and Learn, Gordon Hoffman and Bill Newman join us for the final Lunch and Learn of 2024 with Startup Missteps, Real Scenarios from a VC's Experience. Gordon Hoffman and Bill Newman are entrepreneurs and residents at OBI, providing business guidance, counsel, and advice on the strategic and financial aspects of science and technology commercialization. They formerly managed Northwest Technology Ventures, a seed fund focused on technology-based startups originating in the research sector. Gordon and Bill bring both the investors and the entrepreneur's perspective to advise entrepreneurs and early stage businesses on business and funding strategy. First, we want to give a big thank you to our virtual growth series sponsor, Rain Catalyst. We're going to hear a little bit from Rachel Jagoda Brunette. She's the CEO of Rain Catalyst.
Thanks so much, Adrienne, and good to see everyone here. I will be very quick, but just happy to be able to support this programming. Rain Catalyst, for those who don't know, is a region-wide entrepreneurship support organization that provides guidance, access to capital, education, and networking resources to entrepreneurs across a number of different sectors, including those in the bio and life sciences. We're a very proud partner with Otradi and OBI and others on life science specific work. One quick plug I want to put in while I have the microphone right now is that we are going to be hosting a virtual accelerator program next year that is open to companies in the broad tech industry who are at the point of being ready to scale. So well aligned with some of the work that OBI and Otradi are doing. So please stay tuned on the website raincatalyst.org for more information on how to apply for that and learn more. With that, I will not get in the way of the speakers that everyone's here to see, but just really pleased to be a part of this and to be able to support this great work. Thank you.
Thank you, Rachel, and thank you to Rain Catalyst for sponsoring this for us today. All right, so let's get on with the program. I'm going to go ahead and share my screen. Okay, can everyone see? There we go. Can everyone see that?
Yes.
Yes, okay, perfect. Okay, Bill and Gordon, take it away.
Well, hello, everybody. We wanted to go through some real life scenarios that we're familiar with that we've either been directly involved in our VC experience or know of, or work with other VCs who have run into these. And there's an assortment of them. They're not in any particular order. We just thought that each one has a lesson associated with it that might be useful to you. We may get into some details that we won't have time to explain in depth, but you can ask questions about, and maybe we can follow up later. So, Bill, do you want to add anything?
Yeah, and we hope you enjoy this and are entertained as well as learning. We purposely made it in the form of various scenarios that I'm sure you'll be able to relate with one or several of them from your own experiences in business and in the entrepreneurial environment. These are not going to be PowerPoints going over general points, but rather just sort of everyday situations that we've encountered as investors over the years.
Okay, so we can have our next slide and our first scenario. This is a scenario where VCs were very excited about a university spin-out. There were a number of founders. They were looking for their first significant round, and they wanted, they told us anyway, an institutional round. The VCs had done their homework, done the due diligence, and actually came with a term sheet with industry standard terms, and the VCs were experienced in dealing with university startups. That's what they did. Now, some of these terms were apparently unfamiliar to the founders. These included reverse vesting of the founders' shares, and they felt that was unconscionable and a deal breaker once we explain it, and I'll explain it in a minute. Furthermore, the valuation was lower than they believed justified, and the VCs were escorted to the door, and that was the end of that. So basically, they stole a failure from the jaws of victory because they had a term sheet, and all term sheets are negotiated, but they didn't bother to negotiate. They simply threw the VCs out. Now, this is an unfortunate situation. What it says is that the company had not done their homework ahead of time to determine what does a term sheet likely look like from a VC, and apparently hadn't talked to their attorneys. And so they missed an opportunity here. We've seen other problems like this. We even had one where we went in and talked to a couple of university professors, and they were astonished that we wanted shares of their stock for our money. So this isn't the first time this has happened. So what is reverse vesting? Reverse vesting is typically used by VCs in order to keep the founders in place. In other words, if you have typical options, the employees get, say, a 3 or 4 year vesting period. They have to stay that entire period to get all their shares. Oftentimes the founders, particularly in startups where they're from people who don't have a strong business background, just issue the shares without any kind of vesting. And so reverse vesting is just a statement that's put on the founder shares that they have to stay so many years. And for instance, if they stay a year, then they are vested in a quarter of their founder shares. They stay 4 years, they're vested fully. It's typically done, particularly if, for instance, there's only 2 founders. One founder has maybe a very beginning, say a 40% interest, and then decides, as unfortunately many university startups or startup founders do, is the business side doesn't interest them. They want to go back to the lab, or if they're physicians, they want to go back to their practice. So this is put in so that you don't have a founder sitting there with a bunch of stock that's not actually involved in the company and building value. And if you have that kind of situation, it's difficult to raise money. So it has to be addressed some way, and reverse vesting is the most common. There's many other terms that VCs have: right of first refusal. If a founder wants to sell his stock to a third party, they have the right for the company to buy it back, or the investors, or they can go with a co-sale and join the founder who's selling his shares. There's a lot of these terms: no shop requirements. Founders can't take the term sheet given by one VC and shop it. There may be employment contracts and board roles, investor rights agreements, all kinds of things. The term sheet is just usually a 1 or 2 sheet document that lists the basic terms and values. In the end, you can see this is a document that's pretty thick. This is the preferred stock purchase closing documents. And these, in addition to the term sheet, are actually oftentimes reviewed by both the company and the investors and adjusted as it goes. But it's a pretty comprehensive set of documents. This is definitive. The term sheet is not. It just sets the basic high-level requirements. So, given this, we want to also talk a little bit about this time about the valuation issue. This always comes up in a term sheet. And valuation is obviously negotiable. And to give you an example, suppose the company has a $4 million pre-money valuation. The investors are putting in $2 million. The post-money is $6 million. At that point, the investors own a third of the company's stock. If the valuation were $10 million, the investors put in $2 million, then the post-money would be $12 million, and the investors would own a sixth of the company. And of course, there's always this tension between founders that want to keep the dilution low and investors who want to set a value that allows them to actually make a decent return, since they're taking a lot of risk, particularly in an early Series A. And the situation can be addressed in many ways, not just by valuation. It can be addressed by other mechanisms. The stock that's being issued, in this case, to the investors is called preferred stock, and oftentimes there's various preferences that are allowed. So if the VC, for instance, is forced to accept, if he wants to accept a higher valuation than he feels reasonable, he may put in a preference such that when the company's sold or goes public, usually, well, what actually happens is all the preferred stock is converted to common, but first the preferences are addressed. So a VC may say, well, I put in 2, but when you sell the company, I want 4 back, and then I want to convert my stock to common and participate in the rest of the payout. And if a company doesn't do well and constantly raises more and more money, they can end up with several of these sequential A, B, C, D rounds. We've gone up to G in some of our cases. And each one may have a preference. If the company does very well, new investors come in and they may take out those preferences and say they won't invest with them. So a lot of it, and most of it, depends on how the company does. And these are issues that a lot of founders aren't acquainted with, and they should rely on business advice. Usually it's from an attorney who's done these kind of deals regularly. Bill, do you want to add some things?
One point related to these various terms and the investor and entrepreneur point of view. And the title of the slide says it, alignment. It's important that the entrepreneur and the investor both be aligned on what they want to accomplish and how. The investor is typically focused on making sure that the founders are committed and that there's the potential to make money in the investment. So reverse vesting is simply saying that until the company is successful and has accomplished certain milestones over a period of time, should the founders leave, the company would be able to repurchase their shares. Now, when a company is founded, typically the founders assign each other a share of ownership. And it can be disconcerting when an investor comes in and says, well, yes, each of you founders, you each own a share of the company. However, we'd like to have the option to purchase these shares back from you over a period of time, should you leave before that time is up. And from the investor point of view, we call that reverse vesting. The goal is to make sure that the founders are committed to stay at the company and help the company succeed. From the entrepreneur's point of view, that can be upsetting. It could be termed, and we've heard this, as the investors are trying to steal the company from the founders. And that is not the case. Again, it's a question of alignment. Are the investors interested in control? Not generally. Our need is to invest money and have companies succeed. Our investors give us the money to do that. They do not give us the money to take over companies. We'll, over the course of Northwest Technology Ventures, we invested in up to 20 companies over the life of the fund. So clearly, we do not have the capacity to own companies, and our goal is not control. Rather, our goal is to encourage commitment in the management team. So the term, and not to make a pun here, but the term misalignment fits well. Are both parties seeing the needs of the other party? And again, as Gordon mentioned, many of these terms can be negotiated. So it's not a black or white, all or nothing. Is, can the parties arrive at a mutually agreeable position?
By the way, most companies go through many rounds of financing, and the terms change in either round, and sometimes the terms are reversed and so forth. Be interesting that Facebook had 20 rounds, for example, before they went public. And it would be a very interesting thing if we could see the history of all those term sheets for each round, but we'll never see that, I'm sure. So are there questions from the audience here?
All right, let me check to see if we have any questions in the chat. I don't see any. If anyone has a question, you can either pop it in the chat or feel free to take yourself off mute and ask a question.
Yeah, hey, this is really helpful. This is Brian here. I'm curious, are there sometimes, I get involved in contract negotiations, but not in investing in companies. And I'm curious, are there sometimes certain terms that are included that are there essentially as kind of giveaways, either to just, make sure that you are getting favorable terms? And if so, what are some of the things that a company or entrepreneurs would look out for?
Gordon can give more detail, but my basic point is no. This is not really a designed to be a car purchase where each party keeps secret their position from the other. So a term sheet is the basic level of terms in a quote, if they standard investment, if there can be such thing as a standard investment. And the goal is not to give up A in order to obtain B. It really is an expression of the standard and fundamental needs of the investor when they do submit the term sheet.
And don't forget, the investor isn't just giving money. He or she will be on the board most likely and provide guidance. They have Rolodexes, so they can bring in other investors in various circumstances. They have other companies in their portfolio. They can sometimes connect with some of the companies in their portfolio. One could be a customer of another, or they could share knowledge about some particular candidate. So it's a partnership, it's a marriage more than it is just a arm's length transaction. And because of that, you want openness between both parties. And I've been on both sides. I've started, I guess, 4 VC-backed companies. And by the way, when I was presented reverse vesting, I never cared one bit. Just it was conditioned. I wanted the money and I felt that we would make a success, and we did. So there was never a problem. I don't know if we've answered your question, Brian, but I hope so.
Yes, that's very helpful. Thank you.
Shall we move on to the next one?
We do have one more question I sent you, Adrian.
Okay, excellent. The question is, with reverse vesting, do you see terms related to unintentional situations like a health crisis? I could see a founder viewing their equity as a family asset, and if they didn't voluntarily leave work, wanting something more favorable than book value forced sale, or whatever that reverse vesting means. Related, what about situations where continued employment is untenable for the founder due to the control the investors have?
Oftentimes that's covered by an insurance policy on the key founders and key execs. So if that happens, there's some money available. Also, all these terms can be bent by the investors. So it may be that in some circumstances, they may simply ask for voting rights to be removed if they can get other shareholder approval to do it. Because one of the problems, if somebody's sick or not involved with the company and shareholder actions required, they have to vote. So they have to be found, and if they're not involved with the company, they don't know what's going on. And so this has been a real stumbling block for some companies when there's, large holdings out there by somebody who's no longer involved with the company. So all that has to be addressed, but VCs are not unconscionable.
Yeah, there's going to be a document similar to an employment contract. It might very well be an employment contract as part of the investment. And this will be considered, this particular situation will be considered under what are the situations where a founder can be terminated, and under what situations can the founder's shares be purchased back. So will the founder be terminated for cause or without cause? In each of those conditions, is the founder going to be required to sell their shares back to the company, and at what price? Those will be determined contractually prior to the closing of the round. And so in the situation that you're describing in the question here, that will be handled under the terms of the investment.
Yeah, but as I say, usually there's insurance policies taken out also to deal with some of these.
Key man
insurance, yeah. Because it does happen.
We do have one more question, but I'm going to hold it until the end when we have our big Q&A, just for the purpose of time.
Yep. Okay, well, let's go. If you don't mind, everybody, let's go to the next one. Mel, do you want to lead this one?
Sure. So this is a question that we see quite frequently. It relates to bridge funding, and there's 3 scenarios here, but they're all quite similar. In the first one, the company has raised initial funding via a convertible note from angels, and the company has achieved a certain amount of progress, but they determine that they'll be better situated for later investment if they can open up this bridge round and raise additional money to make some progress in their commercialization. And then the second scenario is, again, a variation on theme, opening up the round to a different amount to enable the company to continue in operation for another half year before going to seek additional funding. And then the third one, right at the very front, the company is looking to raise money via convertible note to make significant progress to position themselves for a Series A funding. Well, the bottom line here, the basic point under every single one of these is, what is the purpose of bridge funding? Okay, bridge funding at an early stage in a company's founding is designed to position the company to raise equity funding. It's intended to be interim funding to enable certain initial business milestones to be met so that the company will be well situated to raise Series A funding. And the goal is to use this funding, in this case, to reduce the risk that the company will not be able to raise the Series A. Well, in each of these situations here, the funding is being used to do that, but then it's being used to do more. It's being used to accomplish significant business milestones that significantly, if successful, reduce the risk of the company not being successful. The problem is that the bridge investors put in the money under the understanding that should the company be successful in raising the Series A funding, their money will purchase shares in the Series A at the price of the Series A round. Now, what they are doing is providing funding to de-risk the company for that Series A. And in each of these scenarios here, the company is actually raising additional funds needed to make further business progress, further de-risk the company to obtain a more favorable position for raising a Series A. So the bridge funders are providing money to de-risk the company, yet when they invest in the Series A, they will not be paid for the risk they are now taking that bridge funding might not accomplish what it's needed. So here, the bridge funding and the investors' money and appetite for risk is being used in some sense against them by accomplishing goals that might be better addressed in raising the Series A. And the bottom line here is that the bridge funding should be used to prepare or position the company to raise a later funding round, not to replace that funding round. Gordon, you want to elaborate?
Well, in the notes, we should talk about this. Usually there's a conversion cap, right?
Typically, when the Series A occurs, sure, if the valuation of the company is higher than a certain amount, the bridge funders are entitled to invest at that lower amount.
Yeah, but that sometimes that may cause a problem with the Series A investor.
And if it's too low compared to the Series A investment round, that might cause a problem with the Series A investors. Again, alignment here.
Yeah, and the Series A may say, no, they have to convert here, so you got to change the terms of the note. It leads to some, shall we say, misalignment. So are there any questions from the audience?
Let me look here. I don't see any. Does anyone want to go off mute and ask a question before we move on to the next scenario?
I guess I'll make one more point here. Again, consider the perspective of the parties. The bridge investor, typically an angel investor, is saying, I will place money in to help the company raise a Series A. And I'm taking the risk that they may or may not get to that point. By raising money to make further progress, the investor is being asked to take on risk and yet not be paid for that risk, because should the Series A occur at a price representative of the progress that the company's made, the angel investor then is not being paid for the risk they're taking in helping the company get to that point. So is the investor's perspective being taken into account?
Right. So throughout all of these things, there has to be a balance between the investors and the company, and both sides have to understand the other's position. So particularly with startups where the founders and or the CEO don't have a business background, they have to get assistance. It's either their attorney or they hire someone who can help them with it. I mean, a lot of times you'll hire a CFO at some point, and that CFO should be experienced. You don't have to have everything yourself. In other words, just because you don't know, you don't have to go get an MBA. So,
Scott, did you want to ask a question?
Actually, my mouth is full with my lunch.
Okay.
So I'll wait for,
Okay.
I mean, yeah, I'm good. Thanks.
Okay, anyone else want to pop on, ask a quick question? Okay, well,
okay. Here's the next situation. We call it overvaluing the company. So here's a company that's making their first pitch to institutional investors. And I remember sitting in this meeting. They've raised a significant amount of money from their family and friends, but they priced around instead of doing a convertible note. And now they need money in a Series A to bring their product to market. Classic. Now, the problem is the post-money valuation for their seed round, that's basically, stock price times the number of shares, was unusually high compared to comparable startups. But because they're family and friends, the founders have said, hey, we're not going to budge. And we have to have an up round because we have to show our family and friends that they can see increased value to their stock. And the problem here is that the valuation doesn't fit with where they're at. In other words, an investor who studies the market and looks at comparable companies would say they're way too high in valuation for the Series A. And in this particular meeting, one of the investors stood up and actually said something. I can't repeat what he said, but he basically walked out of the meeting. And as far as we know, they were never able to raise the Series A. And the net result was everyone lost their money completely, including family and friends. So again, you can say to yourself, hey, I want this high valuation. Matter of fact, the founders, I remember, were talking to me outside, talking to Bill and I outside, and they said how proud they were. They had so little dilution when they priced this round with their family and friends. Well, they priced it too high. But the family and friends weren't institutional and they just went along with it. So you've got to be careful if you do a price round. That's why convertible debt is so popular, because the price of the company will be set by presumably sophisticated angel or institutional investors, and not by the company where the family and friends aren't sophisticated. So what do you say to that?
Yeah, and I'll just make a point here that may be elementary for some, educational for others, but in any investment, valuation is a term that's either implicit or explicit. So for example, if an investor offers to invest a certain amount of money for a certain percentage ownership of the company, well, the valuation of the company is implicit there. So if the investor invests $1 million and is purchasing 25% of the company, then implicitly the company, once the investor has invested, is worth $4 million. It can be explicit. The company can say, we will take an investment of $1 million, assuming that our company is now worth $6 million. So once the investor invests, with that additional $1 million, the company is now worth $7 million, and the investor owns 1/7 of the company. So their valuation is explicit. But investment, share ownership, or share of ownership, and company valuation are all intertwined. So a high valuation on the company means that for an investor dollar, they're purchasing relatively lesser amount of the company than for a low valuation. From the company's point of view, having a high valuation is great. It's selling less of the company per dollar than with a low valuation. On the other hand, from the investor's point of view, having a high valuation means that their percentage ownership of the company is correspondingly lower, and the company has to achieve a much greater level of financial success later on for that share of ownership to be able to pay the investor back. So there can be again, misalignments here where what seems to be good for the company actually prohibits investment. And on the other side, a too low valuation, giving the investor a high share of ownership in the company, can be very disincenting to the entrepreneurs, to the company, and lower their motivation for company success. So again, there has to be middle ground reached in that both parties are comfortable with the outcome. It does have to be a win-win situation, because following the investment, the parties, the investors and the company, are tied together at the hip, for better or for worse, until ultimately the company is either sold and goes public, and the investors and founders can finally be financially rewarded for their efforts.
Right, but it points to a problem where founders are often preoccupied with this dilution business, and they lose sight of it. And they don't have the big picture. It's 15% of a great success is worth a lot more than 40% of a failed venture. So both sides have to be aligned and the price fair. Fair is of course a relative term, but it has to be one that both sides agree makes sense. Questions?
Okay, we don't have any questions in the chat. Does anyone want to unmute themselves and ask a question, or shall we move on to the next scenario? All right, we move on.
Okay. Bill?
So this is an interesting one here, bank debt. Company B has just raised a 5 million Series B from a venture capitalist. That sounds great. And with that as security, the board now recommends that the company can seek debt to augment this investment capital. And they found a bank that will provide what's called venture debt up to $3 million. And this extra cash will, in the terms used, extend the runway of the company beyond the $5 million. Well, although this sounds good, that debt is more than likely going to come with some very strong covenants. Covenants meaning that if the company's cash position goes below a certain point, if the company's sales performance doesn't achieve certain levels, the bank will be able to step in and exact certain terms. The most severe of those terms would be that the bank would be able to call its loan. And in that case, unless the company has the cash to pay back the loan, the company will be out of business. And we had this happen to a company of ours, where the company was able to raise debt, but had a covenant that cash could not go below a certain level. Not surprisingly, that level was the amount of debt that the company had raised. And once, at one point, the cash balance of the company dipped below that covenant level, the very next day, the bank stepped in, filed a lien, froze all the bank accounts of the company, and took their cash. That was ultimately remedied by investors stepping in to put up additional capital, but it shows the risks that can occur. Even more so than this is for a startup company, once that company uses some of its investment capital on the accounting books, it will now have negative net worth. Well, negative net worth is often a covenant, but it's also plays into board roles. The board has the fiduciary responsibility to manage the company for the benefit of the shareholders. But if the company is insolvent, the board's responsibility, and they are legally liable for this, is to manage the company for the benefit of the creditors who are superior in the company's balance sheet to the equity shareholders. So that in the case of insolvency, the board is required and can be sued if they do not act in the benefit of the creditors. So obtaining this so-called venture debt can be a mixed blessing at best, because the money may not really extend the runway. And in fact, it could do the opposite. It could curtail the runway of the company.
This is a problem that occurs, I hate to say it, more frequently than I'd like. I think we had it in 3 companies.
Is that right?
Yeah. In one company, that was during the recession, the investors couldn't raise money from their limited partners to keep funding the company when they stumbled. So the venture debt company called the note, couldn't pay the note. They took all the assets of the company, which was collateral, and sold it to the lowest bidder. If the investors had sold it, we'd have gotten a lot better deal. And that was a great company that stumbled, bad timing with the recession. And the bank did their thing because the bank just wants their money back. They don't care about the future of the company. And that's their responsibility to their shareholders. So it can be a nasty situation. And I do remember one company, we got the call, I think it was either early morning or late at night, and the founder was literally in tears when his bank accounts were locked up and swept. So fortunately, someone stepped in, but when they step in the last minute, guess what? Their terms to provide money are, shall we say, different.
So keep in mind, again, the perspective. The perspective of the investor is that they are willing to take risk because they have a partial ownership of the rewards of the company should it be successful. This perspective of the lender is that they need to get their money back. If the company is successful, they get their money back and no more. If the company is not successful, they risk to lose their money. So there's no upside for the bank and a very severe downside. Consequently, the bank will be very, very, very careful to prevent that downside from occurring, even to the extent of eliminating the upside.
Okay. I see a question, know your bank, they're not all the same. It's true, but they all have a responsibility to shareholders. The terms can be different. How they act, they may call the company before they lock up the bank accounts, I imagine, but these were 2 major, well, we had 2 different ones in our company.
Yeah.
2 major banks. I'm not going to name them, but so.
Any other
let's see.
questions?
Looks like we have a question. What might be a good scenario to take on bank debt?
Can you collateralize the debt? Do you have debt coverage in your P&L? Under those cases, you would be a much less risky venture for the bank and for the company itself.
Yeah, and sometimes people take it on to buy equipment, and worst thing that happens in that case is the equipment is grabbed, not the whole company. So you can set it up that way. And of course, in biotech, sometimes the equipment's mighty expensive, so you have to think about that. But usually the equipment's collateral, not the company's.
Keep in mind, the investor wants to manage risk with the goal of eventually reaping a reward. The lender wants to minimize risk because they must get their money back.
I think we should probably go on. It's getting a little late, so.
Yeah,
Okay, we'll go to
this
the
is an
next.
important one.
Yeah, well, it follows this one we just talked about. If your cash on hand suddenly goes to 0 because your bank debt has, your banker has seized your funds, and your burn rate was so much per month, well, you have 0 months to live. So at any rate, cash management is one thing we see, shall we say, problems with in many of the companies we've invested in. if you regard a business as a living entity, cash is the blood. And when the blood drains out, the company will die. So how do you use the cash? How do you manage the cash? We've seen so many times where even the management of the company isn't on top of it, and suddenly comes to the realization they've got 1 month left. You can't raise money from institutional investors in a month, as you all know. It can take 3 to 6 months to actually close and generate those huge purchase agreements. So you're limited. You have to go back to your original investors on hands and knees and get some. So it's a common thing. Plus, a lot of the money sometimes is spent poorly. And I use poorly as a definition of, shall we say, not money spent for the purpose of increasing the value of the company. I know Mal Ellis is online, and he sent me an example when he was in the venture world where one of the companies he fortunately didn't invest in, the first time they got their money from the investors, they went out and bought a company car. What was that company car? A Jaguar. Was it necessary to buy a Jaguar? Well, a Chevy would have done it. So that excess money didn't really add value to the company. We have dozens of stories like this. I remember when I had a company, a software company, and I visited a company in Massachusetts, and I walked in. They had this fancy new conference table made out of malachite, copper ore, must have weighed 5 tons. And for 30 minutes, that's all they talked about, how proud they were to own it. When we left the company, we said, well, they won't be here in a year. And sure enough, they weren't. Now, one of the things that you can do when you set a awareness in a company, excuse me, is to talk to your employees who all have stock options and explain that the money that you're spending on expenses like furniture and travel and so forth, basically in a way comes out of their pockets, because when the investors buy stock, that dilutes the existing stock that's out there for the founders and employees. And so when you sell the company, they're going to get less. So you need to be frugal. And my example was in one of my companies. I sat down and had this conversation, and we went out and bought 42 workstations, that is desks, chairs, file cabinets, and partitions from the surplus at Tektronix. And for 42 stations, we paid $2,200. And that became a point of pride for the company going forward. They all looked, every time we met, have we wasted any money? So it's good to set up that. You don't want to go too far with it, because certainly in biotech, you've got to spend money on equipment. But make sure you have a culture that values cash and tries to preserve it and not spend it in ways that are really not directed to improving the valuation of the company over time.
Yeah, again, bottom line, as Gordon said, cash is the lifeblood of the company. For a pre-revenue company, where does that cash come from? Investors. What to investors is the best predictor of success in the future? It's success in the past. Therefore, the company better be using that cash in the most efficient way possible to be able to make business milestones that will enable those future investments.
Yep. Well, are there any questions? Because we need to get going. I want to make. Are there questions?
We do have a question here, but if you think it would be beneficial to keep going and save the questions to the end, we can do that. Otherwise, I'm happy to say it aloud.
Your call, because we have more scenarios than time, so.
Yeah.
So let's go ahead and dive into this question then, unless Adrian opposes.
Well, which one are you talking about?
Okay, any perspective to share on the transition from funding coming from grant and research prize sources, such as for R&D or early commercialization readiness of new technology, to equity funding and what equity investors are looking for? How do those grant/prize wins translate to company valuation to investors?
Well, I would say they don't they're very attractive to investors because progress is made to build the value of the company that's non-dilutive. And so it's very positive to investors. And the money, of course, and how it's spent is carefully controlled by what you put in your grant application, and then your grant is audited, so it's all very well controlled. So it's a good thing. I don't see a downside for getting it, other than it's a different world when you're grant writing and when you're raising money. So you have to understand those two worlds.
Keep in mind too, that the grant tap is eventually turned off. The grants, specifically SBIR grants, which is the type that most companies here at the OBI use, are meant to achieve certain milestones that will enable investors to provide the cash and provide the company with the accomplishments and credibility so that investors will invest. They're not meant to substitute for investor cash. So again, the company better be using that money efficiently, because it is not unlimited and it has to accomplish milestones that will transition the company to the next source of cash.
Hope that answers. We tried.
Great,
I
thank
thought
you.
it-
No
can I-
further questions in the chat, and since you have a couple more scenarios, perhaps we shift to the next one, unless.
I think you
Yes,
should
go ahead,
comment
Walter.
on I think there's another answer to that question. And
Oh, okay.
and I think many of the people think the grant monies count towards valuation. They do not add directly
No.
to the valuation. So I think that's the other side of the question that a lot of founders ask. And you talk to the venture capitalists, they'll tell you the amount of money you raise as a grant doesn't add anything to the actual valuation. It's what you've achieved.
That's a very good point. It's not the amount of money, it's what you achieve with the money.
Yeah, I thought I said that up front, but maybe I didn't, or didn't say it clearly enough. But yeah, you use the money to advance the value of the company. It's the value of the company that the investors look at. And if you raise the money and use it well and advance the value, good for you. Because now you have a more valuable company and you're going to have less dilution when you do get financed. Okay, let's go on with this next one. I think this may have to be our last one, but. Well, recruiting the CEO, this is not an uncommon situation where a professor, university person has an invention, starts a company, uses family and friends, but he's uncomfortable with the fundraising process and business issues in general. And he doesn't have anybody in his stable to really talk to, so he meets an experienced person, but not a technologist, known in the community, decides to offer him, I can't remember if it was 20 or 25% of the company in this situation to become the CEO, since he couldn't offer him the salary he expects. Now, obviously, if the professor isn't an experienced businessman, he's made a big business decision, because hiring the CEO is probably one of the most important things you can do. And unfortunately, in this particular company's case, the CEO did not work out. And there was no reverse vesting or employment contract. So then the CEO kept his money or kept his stock, and that made it very hard for this company to raise money. They eventually found another CEO who did have a technical background and worked very well with the company, but unfortunately he was hamstrung by this particular stock stuck out there. And I have a feeling, and I can't remember the details, but I think the CEO wasn't very happy. So he was a dissident shareholder in this whole process, and that didn't make it good for shareholder actions. So you got to be careful, and don't hire CEOs too early. You can contract with people in accounting and other areas to get comfortable with some of the basics, get good advice, and be very careful about hiring CEOs. And, get a board, set up a board that has business people on it to advise you if you don't know. It's not hard to do, but some people just don't do it. And it's unfortunate. Any comments?
Well, a key point here is, was this person who was hired truly a CEO for a pre-revenue, probably pre-product
Right.
technology company? Or were they better qualified as a business advisor? And confusing those two, as Gordon mentioned, can lead to problems down the line when you have a significant shareholder whose role is no longer relevant to the company's needs.
By the way, we see this problem even in venture-backed businesses where the venture folks want to bring in a really expensive CEO from a big company. And yet the small company hasn't really proven out their product yet. And there's a misfit there. And that big CEO can spend too much money of the company and send it into a tailspin. So unfortunately, that's happened to us too. So
Yeah.
we couldn't stop it, but. So at any rate, the CEO has to fit with the times and has to really understand where the company is and have the experience to do it. And he should, if the company's still in an early stage, have a technical background. Or or have the ability to hire somebody he really depends on. I could make stories, but we don't have a lot of time for stories, so. Any questions on that?
No questions on that topic.
Do you want to,
Do we have time, or do we stop here, do you think? What do you think?
it's 12:57, what should we be doing here? I look to Adrian and Heather for this.
Yeah, I would
Right.
say let's go ahead and forward it to the question and answer section. And then perhaps we get to invite you back and we can finish up with the rest of the scenarios in a future time.
Yeah.
Wonderful. There were two questions that we haven't gotten to yet. The first is going back to the term sheet discussions, and it was, have you seen red flags in a term sheet that would have been detrimental to the founders?
Well, not in the term sheets we prepared, I could say that.
Yeah, there are different investors out there, and you have to do your diligence on the investors. Are those investors, do they have a track record? Do prior investee companies speak well of them? Were the investors contributing to the actual success of the company? In other cases, we've seen the investors actually were more looking to gain consulting contracts to the company, where they might invest a small amount of money, but then take significant fees for things like introducing the company to follow-on investors, convincing the company to hire them as interim management and take management salaries there. So you have to be careful that you're getting the right kind of investor.
An investor that can help. I mean, investors should look at the company because they're not going to pull the wool over anybody's eyes over time. So it's foolish for an investor, a sophisticated investor, to try to do something that would harm the company, because we're both going to be losers. So you want to be, as I say, it's a marriage. So when you get married, you'd like to both be committed to making the company as successful as you can. And so I guess there are some investors out there, but I can't remember. You've seen more because you were in another venture company before.
Right. Well, one attorney that we worked with, a very, very well-respected attorney in town, commented this way upon investment terms. He says, if either the investor or the company has to rely upon legal help to enforce the investment terms,
Right.
then that investment is by definition a failure.
Yeah.
It looks like we have one last question, if you don't mind touching on it quickly. It is, you two have seen a lot of new waves of technology over the years, and hopefully this can be quick. What is your take on the impact of AI on tech startups and other aspects of life? Do you think we will have AGI and that it will be bigger than anything you've seen in the past?
Well, I'm gonna make one comment. You know, VCs and investors seem to go in herds. AI is a hot topic. And a lot of companies are throwing AI into their business plan, mostly to attract investment, not necessarily for its veracity, or they could use it, but they're not quite sure how to use it. So I've been told, we haven't been active in this area recently, but I've been told that it's window dressing in some companies. But it is, there will be fallout. The other sort of fad that's going on, people are investing in fusion companies. There's now up to 44 companies venture backed. Obviously, they're not going to all win either. You know?
Yeah, I will second Gordon's comments and also just make the point that anything we say here are the views of Gordon and Bill alone. They are not intended as, nor should they be taken as investment advice.
No. Yeah, I don't want to wade into that one.
Wonderful. Thank you so much to Bill and Gordon. We learned so much. We hope to have you back. This was great information. Also, a special thanks to Rain Catalyst for sponsoring this. This has been recorded, so do expect an email from me in a couple of days where I'll give you a link to the recording and also to the slides that they have provided. We hope to see you at a future event. Please check out our event page on our website, and we'll see you next time. Thank you, everyone.
Thanks, everyone.